Welcome to the part 7 of Option Trading Strategies video series. So trading options for beginners remains my focus, and today's option trading strategy video is about bull call ratio back spread. Over the last 6 parts, I have discussed many option trading topics in detail. In case you have landed directly on this particular video, I would strongly recommend for you to start with part 1 of Option Trading Strategy series. The link to all these videos is in the description box below. So today we are going to discuss about bull call ratio back spread, which is a very aggressive bullish strategy in the stock market. I'll take you through brief overview of bull call ratio back spread along with the basics. And once we are finished with this, I will then explain bull call ratio back spread with help of an example followed by the risk profile for this particular strategy. I will then touch upon conditions when one should think about applying this strategy. And in the end, I will also explain some rules about applying option strategies in general that we have been discussing. So let's get started. So the first thing that we will start with is by discussing bull call ratio back spread basics. Now, bull call ratio back spread is created by buying 2 out of the money call options and then simultaneously writing, that is selling 1 in the money call option. It's important to note that the underlying stock or index remains the same and expiry date for both options should be the same. So for example, if Nifty is trading at 10,000 spot and you buy 2 out of the money call options with strike price of 10,200 for Nifty, that is December series, then you will have to simultaneously sell 1 in the money call option with strike price of 9,800 or 9,900 for Nifty, that is for December series only. So the number of lots that you buy and write should be in the ratio 2:1. So bull call ratio back spread is a strategy which is implemented when outlook of a particular stock or index is extremely bullish. This is when trader expects strong bullish bias to continue and does not expect price to remain in a range. Now, bull call ratio back spread is a 3-leg strategy in which you buy 2 out of the money call option and you write 1 in the money call option. You can experiment with different strike prices to make this strategy more aggressive or more conservative, but I would strongly advise against it. That is in case you are a beginner in this particular strategy. So what I'll do is I'll ask you all to take a snapshot of this screen because this summarizes the strategy that we are going to discuss. So in call ratio back spread, what we are doing is we are buying 2 out of the money call option, writing 1 in the money call option. And this is to be done when outlook of trader is extremely bullish on the underlying stock or index. Few key things that you have to note is that it has to contain the same stock or index futures, expiry series has to be the same, and ratio of 2:1 has to be maintained. So now let us begin with example and risk profile for this particular strategy. Now let me take an example of Nifty to explain bull call ratio back spread in detail. It's important to select an instrument where options are actually fairly liquid. Check for the bid ask spread on your screen or the volume for that particular instrument to see if options are liquid or not. If options are not liquid, that is you don't find good volumes in the options for the particular stock or index, then simply stay away and select another instrument. In this particular example, Nifty is trading at 10,950 and assuming that there are 28 days left to expiry, and view for Nifty is extremely bullish, let's go ahead and create a bull call ratio back spread here and then calculate the various profit, loss and break even points for this particular strategy. So first I will start by explaining the risk profile for this particular strategy and then I will explain the various expiration scenarios. So bull call ratio back spread for Nifty is created by buying 2 out of the money call option at 11,100 strike price at a premium of rupees 35. And then simultaneously we are writing 1 in the money call option with strike price of 10,800 for a premium of 213. So I will come to strike price selection later. For now, just remember that the net premium paid to create this strategy is rupees 70 because it is 35 rupees per lot, and since we are buying 2 lots, we are paying rupees 70 as premium, and the net premium received for writing this particular call is rupees 213. So for now, just remember this thing. So what you see in front of you is the option trading chain for Nifty. Remember, Nifty spot is at 10,950. To create a bull call ratio backspread strategy, we have selected out the money strike price of 11,100 and in the money strike price of 10,800. Now we buy two lots of 11,100 call at rupees 35. That is, we pay a premium of rupees 70 since we are buying two lots. And we also write one lot of 10,800 call option at the rate 213. That is, we receive a premium of rupees 213. Therefore, the net credit in our account is 70. That is, the debit happened when we bought two lots of 11,100 call plus 213 credit that we have received while we have written one lot of 10,800 call option. Therefore, the net credit is rupees 143. So there's a small mistake here. The net debit written here is 72, but it's actually rupees 70 because we have paid 35 rupees per lot. So I hope this particular part is clear. The kind of strategy that we have created here is a strategy that has given a net credit in our account because we have got 213 as credit when we have written the call and we have paid 70 when we have bought the call. So the net credit is rupees 143. Just keep this in mind. So this is the risk profile graph for bull call ratio backspread strategy. Now, as you can see in this particular graph, this is very different from what risk profile charts we have seen earlier. So in this particular strategy, we have two break-even point. This is the lower break-even point and this is the higher break-even point. We also have a maximum risk which is defined and it is capped. Towards this side, you have an opportunity to make potentially unlimited profit, that is theoretically. And in this particular side, you still have odds of making money, but your profit would be limited. So let us recollect that we bought two lots of out of the money call option 11,100 for which we paid a premium of 35, and we have written one in the money call option of strike price of 10,800 at the rate 213, and that is the we have received rupees 213 in our account, and the net credit for this particular strategy is rupees 143. Now from this particular graph, it is clear that odds of making money is more in this particular strategy because we get to profit here, we get to profit in this particular segment, and the only portion where we don't make money is when price stays in a range. Maximum risk for this particular strategy is also clearly defined and it is capped, which means that risk is limited in this strategy. So in this section, I will show you how to calculate maximum profit and maximum loss for this particular strategy. Now, maximum loss in this particular strategy is defined as strike price of long call minus strike price of short call minus the net premium for this particular strategy. So the maximum loss according to our particular example would be 11,100, which is strike price of long call, minus 10,800, which is strike price of the short call, minus 143, that is the net premium credit for this strategy. So maximum risk therefore in points is rupees 157 per lot. So I hope maximum loss formula is now clear. Profit aspect will be more clear once we discuss the break-even points for this particular strategy. So in this risk profile chart, we have seen that there are two break-even points. The first is the lower break-even point and the second is the higher break-even point. At breach of first break-even point, trader is set to make limited profits, whereas at breach of second break-even point, trader can hypothetically make unlimited profit. Now, lower break-even point is equal to strike price of short call plus the net credit that we received for this particular strategy, whereas higher break-even point is equal to strike price of long call plus the maximum loss in points for this particular strategy. So in this particular chart, I have marked out both lower and higher break-even point with respect to the example we are discussing. So lower break-even point, if you remember, is equal to the strike price of short call plus the net credit for this strategy. In this particular case, It is the 10,800 call option strike price, because this is what we have written, plus the 143 that we receive as credit. Therefore, the lower break-even point is 10,800 plus 143, that is 10,943. Now the higher break-even point is equal to strike price of long call plus the maximum loss for this particular strategy. In this particular example that we have discussed, this would translate into strike price of long call was 11,100 plus maximum loss for this particular strategy in points was 157 per lot that we discussed few slides back. Therefore, the higher break-even point would be 11,100 plus 157, which is equivalent to 11,257. So right at the outset, we make limited profit when price of Nifty moves below 10,943, and we make potentially unlimited profit when price of Nifty moves above strike price of 11,250. So the only place where we make loss is when Nifty stays between 10,950 and 10,250. So with Nifty at 10,950, in case you're right in the direction of market, you stand to make unlimited profit. In case you're wrong and market starts to slip below the level that Nifty is trading at, you still get to make some bit of profit. So the odds of making money in this particular strategy for both ways is about 66%. Rest 33 or 34% is when market remains in a range. This is why the odds are actually much high in this particular strategy for you to make potential profits. So as we have seen in this particular example, profit is actually unlimited in one case and loss is actually capped. Now this is sort of a unique strategy that we have discussed, where odds of actually making money are much higher. If market moves up with momentum, you stand to benefit. That is, theoretically you can make unlimited profit, but that is just on paper. Usually profit is also well defined based on how much market moves. If you're wrong in your overall analysis and price starts to slip below the current price of 10,950, you would still get to make limited profit. The only place where you will make loss is if market stays in a range. So clearly the key in this strategy is to anticipate movement in price and then execute this. This is also a strategy that you can use in events where you expect strong momentum in prices. Now, in this particular case, I would tell you that events should be major events and not something like economic data release or let's say even a RBI policy. I would categorize this particular strategy for events something like, general elections would be a very good event to execute this strategy, as market tends to be very volatile around such events. If markets move up, you will benefit a lot in this strategy, and if it moves down during general elections, you would still end up in profits. The only way you won't make profit is when market stays in a range, which is typically very unlikely in an event of as big magnitude as a general election. So I hope this particular point is clear. There's a reason I have released this strategy in December, because there is still about 4 to 5 months to go for general elections, assuming it will be held in May. So you can kind of get a grip on this strategy so that you can execute it somewhere in 2019 to benefit from it. So now what we'll go through is various expiration scenarios for this particular strategy. Now this is the payoff chart for this strategy. I usually put out the payoff chart for each option trading video that I've done. Take a screenshot of this particular payoff chart, that is for your reference. I will now explain some expiration scenarios so that it is easy for you to understand how to calculate payoff in this particular strategy. In case you're not familiar with the concept of intrinsic value, time value, I would urge you to start watching from part 1, because that is where I have explained all these basics in detail. So let us first discuss expiration at 10,900. Now at 10,900, the 10,800 call which we had written for a premium of 213 would have net value of rupees 100, that is intrinsic value of rupees 100. How do we calculate intrinsic value? It is this price at which expiration has happened minus the strike price of call option, right? So therefore the net profit in this particular strategy would be 113, because we received 213. Intrinsic value of this option now is 100. So 213 minus 100 is 113. The 11,100 call option which we bought, that is 2 lots for total of 70, would have intrinsic value of 0. Therefore the net loss for this particular leg would be minus 70. Therefore the net profit at 10,900 would be 113 minus 70, that is rupees 43 per lot. Again, if you don't understand the concept of intrinsic value, time value, and how this calculation is done, I would urge you to start with part 1 of option trading strategies video series, as I've explained all this in that particular part. Link to those videos is again in the description box below. So let us now discuss the expiration at 10,700. So at 10,700, the call option that we had written at 10,800 for 213, that would have a net value of 0. Net profit would be 213. So here there's one more error. This 10,700 should be 10,800 because that was the call option that we had written. So the 11,100 call option which we bought, that is 2 lots for rupees 70, would have a net value again of 0. So the net loss would be minus 70. So the net profit at 10,700 would be profit from 10,800 call option minus the loss from 11,100 call option, which would amount to rupees 143 per lot. So I hope it is now clear how to calculate the payoff in this particular strategy. Now you need to practice this on your own for other strike prices and check your results with the given results in the payoff table that we saw in the previous slide, so that you do know how to get these basics calculation in place, which would essentially help you to strategize better in form of executing this particular strategy. So now I'll put out some rules for you to follow in this particular strategy. The number one thing is that strike price selection is extremely important. For call buying, I would select one strike price away call option, and for call writing, I would actually select 1 to 2 strike price away option. Now, for example, if Nifty is at 10,950, I would select 10,800 call option for writing and 11,100 for buying. You can even select, let's say, something like 11,000 call option, but stick to this particular detail that I've given you. That is to get better at this strategy, and then you can start experimenting. Now, number of days till expiry should be 20 days or more. At mid of the series, if you feel price is very bullish for the next 30 to 40 days, execute this strategy for next series, since only 8 to 10 days would be left for expiry. Let me repeat this again. You should have at least 20 days or more left to expiry. In case you're somewhere in the last week of the current series and you see that price is bullish for the next 30 to 40 days, what you can do is you can execute this strategy for the next series. I hope this particular point is clear. Now, when volatility is too high, avoid implementing this strategy. You don't need volatility to cool off. That would actually hamper the payoff for this particular strategy. If volatility expands with your positions, you would actually tend to profit more. In the end, I would only tell one thing, that avoid too deep in the money or too far out of the money options in the beginning. Probability of losses will increase, and it's possible that you will abandon this strategy. So if you're beginning or if you're a beginner in this particular strategy, stick with what I've given here. That is 1 strike price away call option and 1 to 2 strike prices away for the option that you're going to write. So this strategy is for times when trader is right on 2 components, that is uptrend and momentum. So therefore this strategy should not be executed when either of the 2 is missing. That is, either you cannot see a clear uptrend or you see that momentum is missing. So momentum on the upside should be clearly visible in terms of wide range bars or candles. That is something I have repeatedly discussed in my videos, even the last option trading video. And trend should be clearly identifiable as up, right? Also, do remember one thing, that volatility is actually more cyclical than price, and therefore when you spot volatility expanding from a kind of a low cycle, think of executing this strategy because that is where you stand to benefit the most. Your underlying aim is for price to move. If it moves up, you stand to profit the most. And if it moves down, you would still get to make some returns. It is just that you have to ensure that you don't have to execute this strategy when you visualize that price is going to remain in a range. So now we are covering so many strategies that it is practically impossible to execute each strategy on a consistent basis. Now this is where I'm going to give you some professional guidance because what happens is that there are so many wonderful people on YouTube who have shared so much information for everyone to benefit from. But the key for you guys is not to get overloaded with the information out here. You have to assess your own psychological comfort with the kind of strategies that you see on this channel or some other channel. And once you have assessed your own psychological comfort, you then need to pick the strategy which you will work on further. I hope this particular point is clear. Now see, trading a strategy successfully actually involves two essential components. First is understanding the strategy, and second is making that particular strategy your own strategy depending upon your own risk and psychological profile. Now, too many traders try to learn so many things. This is not the right approach. Focus on what you think is right and then work on that particular method. The point that I'm trying to emphasize is that you have to become a master of, let's say, a pattern or a strategy or a setup. This is the only way you should approach all the information that you see in front of you. What I am sharing here will help you understand a lot of things about market, but in the end, it is you who have to put in all the hard work and you have to consistently practice these strategies. Now, in the end, I'll just tell you one thing, that be it trading or be it investing, this is a very long-term game and results won't come in the short term. Do focus on the long term only and try and focus on the method rather than how much money you are making. So the next part in the options trading series will be about straddle and strangles. And once I finish with straddle and strangle, I will then move to put options segment. What I intend to do here is that once I finish off with these particular two videos on strangle and straddle, I will then take up some put options video, and then we will move towards open interest analysis and picking out trades from options charts. So I hope this particular strategy is clear to you, which we discussed this particular week. In case you have any doubt about what I've shared, just leave a comment below and I'll get back to you as soon as possible. So thanks a lot for watching this video, guys. Have a great weekend and be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.